Ayubowan. Today we are starting the second seminar of the seminar series organized by the Bank of Ceylon, aiming on the advanced level examination. Today in this discussion we are focusing on the fourth lesson of the syllabus, cost of production and market structures. We will start the discussion. So, in the first question we are focusing on the production process, short run production process and then the long run production process. So, before moving on to the question, I will give a brief explanation regarding the short run cost of production and then the long run cost of production. We identify two types of inputs used in the production process, or in other words, the inputs used in the production process are divided into two categories as variable inputs and then the fixed inputs. Inputs used in the production process are divided into two categories as variable inputs and then the fixed inputs. Variable inputs are the inputs which are depending upon the number of units produced. Variable inputs are the inputs which are depending upon the number of units produced. The requirement of variable inputs is 0 at the 0 level of production, and the variable input requirement gradually increases when the level of production goes up. But to the other way, when it comes to the fixed inputs, the requirement of fixed inputs does not depend upon the number of units produced. The requirement of fixed inputs is there even when the level of production is 0, or in other words, the fixed inputs are incurred even at a 0 level of production, and the fixed input requirement remains unchanged even when the level of production goes up. So, based on the types of inputs which can be observed within the production process being considered only, we are categorizing the production process into two categories as the short run production process and then the long run production process. Based on the types of inputs which can be observed within the production process being considered only, we are categorizing the production process into two categories as the short run and the long run, but you must be aware that it is not categorized based on a calendar period of time. Simply we cannot say a period more than 1 year is long run and less than 1 year is short run. No, there is no such categorization of production process. The production process is categorized into two categories. The production process is categorized into two categories based on the types of inputs which can be observed within the production process being considered. We define the short run production process as the time period in which at least one input remains fixed. We define the short run production process as the time period in which at least one input remains fixed. So, therefore, within the short run production process, the production is increased only by increasing the variable inputs while the fixed inputs are held constant. Within short run production process, the production is increased only by increasing the variable inputs while the fixed input are held constant. At least one input is constant or fixed within the short run production process. But when it comes to the long run production process, long run is the time period in which the production is increased by increasing all types of inputs. All inputs become variable within the long run production process. Therefore, we do not identify two types of inputs called fixed inputs and the variable inputs in the long run production process. Instead, all inputs become variable in the long run production process. Right? All inputs become variable within the long run production process. So, this is how we are categorizing the production process into two categories as the short run and the long run. Again, the categorization of production process into two as the short run and the long run is totally based on the types of inputs which can be observed within the production process being considered. So, keeping this in our mind, we will read the first question. Identify the correct statement. Identify the correct statement. First one, short run in production refers to the time period less than 1 year. I told you that the categorization is done based on the types of inputs identified within the production process, but not based on a calendar period of time. So, the first answer cannot be identified as a correct answer. Second one, only fixed inputs can be seen in the short run production process. That is also wrong. Why? We discussed that short run is the time period in which at least one input remains fixed. The production is increased in the short run only by increasing the variable inputs, while the fixed input is held constant. Therefore, both variable inputs as well as the fixed inputs are identified within the long run production process. We will see. So, therefore, the second answer is also wrong and it cannot be identified as a correct answer. Third answer, both variable inputs as well as fixed inputs can be seen in the long run production process. Yes. Why? Right? The third answer again, both variable inputs as well as fixed inputs can be seen in the long run production process. No, wrong. Why? Long run is the time period in which the production is increased by increasing all types of inputs. All inputs become variable in the long run production process and no fixed inputs are identified in the long run production process. Therefore, third answer also cannot be identified as a correct statement. Fourth one, both variable inputs as well as fixed inputs can be seen in the short run production process. True, right? We learned that the short run is the time period in which the production is increased by increasing all types of inputs. So production is increased by increasing only the variable inputs while the fixed inputs are held constant. Therefore, in short run, we identify both the variable inputs as well as the fixed inputs. Therefore, we should accept the fourth answer. Why? Both variable inputs as well as fixed inputs can be seen in the short run production process. We will read the fifth answer as well. Production capacity held constant in the long run production process. That's not a correct statement. It is a wrong statement. Why? In the long run production process, the production capacity is increased. In the long run production process, the production capacity is increased. Not only the variable inputs are increased in the long run production process, but also the fixed inputs, the production capacity is increased. The machineries, land and other kind of fixed inputs which were there in the short run are also increased when it comes to the long run. Therefore, the production capacity will be increased within the long run production process. So, we cannot come into a statement saying production capacity held constant in the long run production process. The production capacity changes in the long run. So, we should accept the fourth as the correct answer for the question number 1. Right. We will move on to the next. Right. Question number 2. Identify the incorrect statement in relation to the short run. As I discussed with you with the first question, short run is the time period in which the production is increased by increasing only the variable inputs while the fixed inputs are held constant. At least one input is fixed within the short run production process. The economic theory which explains the behavior of short run production process is the economic theory which explains the behavior of short run production process is the law of diminishing returns. The law of diminishing returns is the economic theory which explains the behavior of short run production process. First of all, we will define this law of diminishing returns. We define the law of diminishing returns as Within the short run production process, when the production is increased only by increasing the variable inputs while the fixed inputs are held constant, the marginal product and the average product starts to decrease after a certain point. Right? Within the short run production process, when the production is increased by increasing the variable inputs while the fixed inputs are held constant, the marginal product and the average product starts to decrease after a certain point. Marginal product and the average product starts to decrease after a certain point, or in other words, the marginal product and the average product eventually decreases. So it impliedly saying that the marginal product and the average product are increasing up to a certain point, and that is at the initial stage the marginal product is increasing, and after a certain point the marginal product and the average product starts to decrease. So this law of diminishing returns only decide the behavior of product curves in the short run as well as the behavior of cost curves within the short run production process. In other words, law of diminishing returns is the economic theory which explains the overall behavior of the short run production process. So based on the law of diminishing returns only, the shape of the total product curve, the marginal product curve, and then the average product curves are decided within the short run production process. So with the diagram we will see what kind of a behavior is there of the total product curve, the marginal product curve, and then the average product curve based on the law of diminishing returns. We usually use L to identify the variable inputs: total product, marginal product, and average product. So this is how we can explain the behavior of total product curve and then the marginal product curve, average product curve based on the law of diminishing returns. Again, what did we mean by the law of diminishing returns? The law of diminishing returns states that when the production is increased by increasing the variable inputs while the fixed inputs are held constant, the marginal product and the average product starts to decrease within this short run production process. So therefore the diminishing returns are seen only when the marginal product curve starts to decrease. So this is the point at which the marginal product curve starts to decrease, no? Up to this point the marginal product curve is increasing. So during the stage where the marginal product is increasing, we do not identify the diminishing returns. So from this point onwards, that is from this first red colored line onwards only, the marginal product of the firm starts to decrease. Therefore from this point onwards only the diminishing returns are seen. From the first red colored line onwards only the diminishing returns are seen. At the stage where the marginal product curve of the economy marginal product curve of the firm being considered increases, what happens is during this stage the marginal product increases. So during the stage where the marginal product increases, the total product increases at an increasing rate. at the stage where the marginal product increases, the total product increases at an increasing rate. So, as I told you, from this point onwards only the diminishing returns are started. From the first red colored line onwards only the diminishing returns are started. That is, from this yellow colored point onwards only the marginal product curve decreases. But just because the marginal product of the firm decreases, from that point onwards the total product curve does not turn downwards and slope downwards. No, that doesn't happen. But what happens immediately after the diminishing returns are started? Immediately after the diminishing returns are started, you can see the total product curve increases but at a decreasing rate. So, at the stage where the marginal product increases, the total product increases at an increasing rate. At the stage where the marginal product increases, the total product increases at an increasing rate. And when the diminishing returns are started, that is when the marginal product curve starts to decrease, what happens to the total product? The total product increases but at a decreasing rate. Total product increases but at a decreasing rate. Also, at the exact point where the marginal product reaches to 0, at the exact point where the marginal product starts to is reaching to 0, the total product goes to its maximum point. The total product goes to its maximum point. From that point onwards, when marginal product is taking negative values, that is, marginal product further decreases, only the total product curve of the firm decreases. From that point onwards only the total product curve of the firm decreases. So, therefore, the total product curve increases at an increasing rate when marginal product increases, and immediately after the diminishing returns are started, the total product is still increasing but at a decreasing rate. And then when marginal product is 0, the total product reaches to its maximum point. When marginal product is 0, the total product reaches to its maximum point. From that point onwards, when marginal product is further decreasing, the total product curve starts to go down. That is how we can explain the relationship between the marginal product curve and then the total product curve. And now we will see what kind of a relationship is there between the marginal product curve and then the average product curve. We will see this diagram. So, at the stage where the marginal product curve is lying on the top of average product curve. Up to this point, the marginal product curve is lying on the top of average product curve. Up to this red colored point, the marginal product curve is lying on the top of average product curve. So, at the stage where the marginal product curve is lying on the top of average product curve, what happens is, at the stage where the marginal product curve is lying on the top of average product curve, what happens is, the average product curve increases. Average product of the firm increases. And always the marginal product and the average product are equal to each other at the maximum point of the average product curve. Marginal product curve and then the average product curve are intersecting with each other at the maximum point of the average product. From that point onwards, you can see that the marginal product curve is lying below the average product curve. So, at that stage where the marginal product curve is lying below the average product curve, what happens is the average product decreases. at the stage where the marginal product is lying below the average product decreases. So, this exact relationship between the product curves should be there with you in order to answer the questions regarding the application of the law of diminishing returns. Here we explain the behavior of product curves based on the law of diminishing returns, behavior of short run product curves. Right. So, we will go to the question. The question is, identify the incorrect statement. We are supposed to identify the incorrect statement. Right. Identify the incorrect statement in relation to the short run. First answer, total product increases at an increasing rate when marginal product goes up. Think you can remember the graph? Marginal product increases, total product increases at an increasing rate. When marginal product increases, total product increases at an increasing rate. So, it is a true statement, right? It is a correct statement. So, we cannot identify that as the answer. Second one, total product starts to decrease when diminishing returns are started. Total product starts to decrease when diminishing returns are started. DVC. I told you that the diminishing returns are started from this point onwards. That is when the marginal product starts to decrease only, that at that point only the diminishing returns are started, right? But you can see that just because the marginal product starts to decrease from this point onwards, the total product is not going down. During that stage, what happens is the total product increases at a decreasing rate, right? We go to the answer. Second answer, total product starts to decrease when diminishing returns are started. No, it is not. The total product increases at a decreasing rate. So, therefore, we should identify right. The total product right. The second answer, the total product starts to decrease when diminishing returns are started, is a wrong statement. It is not a correct statement. So, therefore, we should accept the second as the answer. We will read the other statements as well. Third one, total product is maximized when marginal product is 0. Right? Total product is maximized when marginal product is 0. We learnt it. So, you can see the total product reaches to its maximum point when the marginal product is 0. When marginal product is 0, the total product reaches to its maximum point. Therefore, it is a correct statement. Fourth answer, average product is maximized when marginal product and average product are equal to each other. Average product is maximized when marginal product and average product are equal to each other. You can see. So, marginal product and the average product are equal to each other at this respective point. So, at that point, the average product reaches to its maximum point. So, therefore, the fourth statement is a correct statement. Fifth statement, average product decreases when marginal product is less than the average product. Right? Marginal product is less than the average product during this stage. During this stage, only the marginal product is less than the average product. So, during this stage, what happens? The average product decreases. During that stage, the average product decreases. Therefore, when average product decreases when marginal product is less than the average product is also a correct statement. So, therefore, we are supposed to identify the incorrect statement out of these statements. The second statement is the incorrect statement. So, we should identify the second answer as the answer here. Right, we will move on to the next question. Right, question number 3. The question number 3 is focusing on the economic profit and then the accounting profit. The question number 3 is focusing on the accounting profit and then the economic profit. We will see with a small discussion how the accounting profit is calculated and then how economic profit is calculated. Within the accounting discussion, the accounting profit is calculated by deducting the explicit cost from the total revenue. From the total revenue earned by the firm, we deduct the explicit cost when arriving at the accounting profit. What do we mean by the explicit cost? The explicit cost is also identified as the direct cost. The money paid to the outsiders to acquire resources from outside of the organization in order to produce the product being considered is what we identify as the direct cost, or in other words, the explicit cost. An organization may have to purchase raw materials, hire laborers, maybe renting out a premises to carry out the production activity being considered, and interest may be paid on a bank loan obtained to carry out this respective production activity. Like this, for the resources acquired by the organization from outsiders, the organization has to incur a cost in relation to this respective production activity. So, the money paid by the organization to acquire resources from outside of the organization to produce the product being considered only is what we identify as the explicit cost. So, therefore, within accounting discussion as the cost of production, what we identify is this explicit cost. So, we deduct this explicit cost from the total revenue when arriving at the accounting profit. When we are calculating the accounting profit, we deduct explicit cost from the total revenue. But when it comes to the economic discussion, what do we identify as the economic profit? Economic profit is obtained by deducting the economic cost from the total revenue. So, economic profit is total revenue minus economic cost. So, when we say economic cost, we need to see what components or what do we mean by the economic cost of production. Economic cost of production comprises of two components. Economic cost of production comprises of two components. The two components of economic cost are the explicit cost as well as the second component is implicit cost. Economic cost comprises of two components. They are explicit plus implicit. These are the two components of economic cost. So, we already learnt about the explicit cost, which is a part of the economic cost as well. What did we mean by the explicit cost? Explicit cost refers to the money paid to the outsiders to acquire resources from outside of the organization in order to produce the product being considered. An organization may be acquiring resources from outsiders to carry out the production activity being considered, and at the same time an organization may be using its own resources to the production activity being considered. The owner of the organization may be working for his own organization. So as a result, he loses the opportunity of working for some other organization and earning a salary income. At the same time, the owner may be investing his own financial capital to carry out this respective production activity. As a result of investing his own money in this respective production activity, he loses the opportunity of investing this money in some other organization, maybe in a fixed deposit or maybe buying shares of a company, some kind of an investment, and he could have generated some investment income from that. All these will be foregone as a result of using the owner's own resources to this respective production activity. So, what do we mean by the implicit cost of production? What do we mean by the implicit cost of production? Implicit cost of production refers to this foregone income from the resources owned by the organization itself, which are used into this respective production activity being considered. We define the implicit cost as the opportunity cost of the resources owned by the organization itself. We define the implicit cost as the opportunity cost of the resources owned by the organization itself, which are used into the production activity being considered. Right? We cannot simply say implicit cost is the opportunity cost. No. What do we mean by the implicit cost? It is the opportunity cost of the resources owned by the organization itself used into this respective production activity being considered. So, therefore, both implicit cost as well as the explicit cost should be deducted from the total revenue of the firm in arriving at the economic profit. So, based on this discussion, we will calculate the economic profit based on the given information in the question. Right. So, again, economic profit is total revenue minus economic cost. We will calculate the economic cost based on the given information. A person starts a business of producing bakery products. For this, he used his own savings of 1 million rupees, from which he earned a monthly interest income of rupees 20,000. So, as a result of starting this respective business activity, the production activity, the organization, the owner loses the opportunity of earning an interest income of 20,000 by using his own financial capital. Therefore, we should treat this 20,000 as an implicit cost. This 20,000 should be identified as an implicit cost. We will continue. Also, he resigned from his job, from which he earned a monthly salary of rupees 50,000. So, when the owner invests his own money, when the owner works for this organization, when the owner works for his own production organization, he loses the opportunity of working for some other organization and earning a salary income. If he did not do this respective business activity, if he did not do this production activity, if he did not provide his labor to this production activity, he could have provided his labor to another organization and could have earned a salary income of rupees 50,000 according to this explanation. which is another implicit cost of this respective production activity. Right. During the first month of operations, he sold bakery products worth of rupees 400,000. So the total revenue of this business activity, this production activity, is how much? Is 400,000 rupees, the monthly revenue. He incurred rupees 80,000 on wheat flour. So he is acquiring wheat flour from outside of the organization. For that he has to pay 80,000 on this respective production activity as the cost on raw materials. So therefore this is a cost incurred on acquiring resources from outside of the organization, which is an explicit cost. So therefore this 80,000 is an explicit cost of this respective production activity being considered. And then paid rupees 100,000 for salaries and rent. He has to pay 100,000 rupees for the laborers or the employees working in this organization, and as rent, altogether 100,000 rupees. So this is also a cash payment from the organization to the outsiders. No? Therefore that is also an implicit cost of this respective production activity being considered. So this 100,000 is an explicit cost because there is a money outflow from the organization. So 20,000 rupees of foregone interest and 50,000 of foregone salary are the two implicit costs identified here. 80,000 rupees paid on raw materials plus 100,000 paid on salaries and rent are the explicit costs identified in this respective production activity. So therefore foregone interest income of 20,000 and foregone salary of 50,000 are the implicit costs of this respective production activity. And then 80,000 paid on raw materials, the wheat flour and other ingredients, plus 100,000 paid as salaries and rent are the explicit costs associated with this respective production activity. Therefore, the total cost of this respective production activity is 250,000. The total cost associated with this respective production activity is 250,000. And the question says that the total revenue earned by them is 400,000 rupees. So therefore the firm generates an economic profit of 150,000. The firm generates an economic profit of 150,000 rupees. So this is how we can calculate the economic profit in relation to a certain production activity. So we will refer to the answers. 5 alternative answers are given. With the calculation we made, we identified that the economic profit is rupees 150,000. Therefore, the answer should be the third answer, rupees 150,000. Answer should be the third answer, rupees 150,000. Right. We will move on to the question number 4. The diagram given below is related to a firm operates within the short run. The diagram given below is related to a firm operates within the short run. With this question, I am focusing on the behavior of short run total cost, the behavior of short run total variable cost, and then the behavior of short run total fixed cost. Right. With the diagram, we will see what kind of a shape is there to these respective cost curves in the short run production process. Quantity of output, the value in rupees. The total variable cost curve takes this kind of a shape. The total variable cost curve starts from the origin, and initially it increases at a decreasing rate. After a certain point, the total variable cost is starting to increase at an increasing rate. The reason for the behavior of the total variable cost is, the reason for this shape of the total variable cost is the law of diminishing returns. We learnt about the law of diminishing returns with the previous discussion. The law of diminishing returns states that when we increase the production by increasing the variable inputs while the fixed inputs are held constant, the marginal product and the average product starts to decrease after a certain point, right? And then we learnt about variable inputs at the beginning of the discussion. What did we mean by the variable inputs? The variable inputs are the inputs which are depending upon the number of units of output. So the requirement of variable inputs is 0 when the level of production is 0. So therefore, the cost incurred on variable inputs, that is, the variable cost is 0 at a 0 level of production. Variable cost is 0 at a 0 level of production. Therefore, the total variable cost curve is always starting from the origin. The total variable cost curve is starting from the origin, and it increases at a decreasing rate first at the stage where the marginal product is increasing, and when the diminishing returns are started, the total variable cost curve increases at an increasing rate. The total fixed cost is the cost incurred on fixed inputs. So there is a certain decided amount of fixed cost for the organization. So that is there is a certain amount of fixed cost of the organization. So the total fixed cost curve is starting from that respective point and is moving parallel to the quantity axis, to say that the fixed cost is not depending upon the number of units produced. To say that the fixed cost is not depending upon the number of units produced, the fixed cost is starting from that respective value and is moving parallel to the quantity axis. And then the total cost is the sum of total variable cost as well as the total fixed cost. Total cost is the total of total variable cost and the total fixed cost. Therefore, the short run total cost curve is starting from the total fixed cost, because when the level of production is 0, the variable cost is 0 and only the fixed cost is incurred at a 0 level of output. Therefore, at 0 output, the total cost is equal to the total fixed cost. So the total cost curve is starting from the total fixed cost and is moving parallel to the total variable cost curve. Total cost curve is moving parallel to the total variable cost curve. The vertical gap between the total variable cost curve and the total cost curve represents the total fixed cost of the firm. The total fixed cost does not depend upon the number of units of production. So the total fixed cost is a fixed figure. Therefore, the total variable cost curve and the total cost curve are moving parallel to each other. So therefore, we will go back to the question. The total cost curve is starting from 600. That is, when the level of output is 0, the total cost is 600. What does it mean? We learned that when the level of production is 0, the variable cost is 0. But even when the level of production is 0, the fixed cost should be incurred. So therefore, the 600. The starting point of this total cost curve represents the total fixed cost of this firm. Represents the total fixed cost of this firm. The starting point of the total cost. And then according to this diagram, when the level of output is 30, the total cost incurred by the firm, when we move along with this to the total cost curve and identify the corresponding value, the total cost of producing 30 units is 1500 rupees. So we learned that the short run total cost is comprising of two components, the short run total variable cost and then the total fixed cost. Short run total variable cost and then the short run total fixed cost. At 30 units, when the firm is producing 30 units, the firm has to incur a total cost of 1500 rupees. We already identified that the fixed cost of this firm is rupees 600. The fixed cost is not depending upon the number of units of output. So fixed cost is decided as a certain amount and remains unchanged even when the level of production increases. So the short run total cost is the total of total variable cost and then the total fixed cost. We found out that the total cost at 30 units is 1500. Also based on that diagram, the total fixed cost of the firm is 600. So what does it mean? The total variable cost of the firm is, the remaining figure is 900. Therefore, the total variable cost of the firm is rupees 900. Total variable cost of the firm is rupees 900. So we will go to the answers, right? According to the above diagram, the total variable cost of producing 30 units is how much? Is rupees 900. We found that with the previous discussion. So it is rupees 900. Answer number 2 is the answer based on the calculation we made before. Right. We will move on to the next question. Table given below shows the cost behavior of a firm operates within the short run production process. Table given below shows the cost behavior of a firm operates within the short run production process. Output is starting from 1 and going till 6. Total cost is 500 at 1 units and it gradually increases, and then the marginal cost is also given. We will see the question. According to the above information, average variable cost of producing 5 units is. We are supposed to calculate the average variable cost of producing 5 units. Right. So they have given us the total. They have given us like they want us to calculate the average variable cost of producing 5 units. Average variable cost of producing 5 units. But the given information contains only the total cost and the marginal cost. So in a certain way, first of all, we should calculate the total variable cost at 5 units. We should calculate the total variable cost at 5 units. So they have given us total cost at 5 units. The total cost is rupees 900. Total cost is rupees 900. At the same time, if you look at the starting point of the table, it says if they produce 1 unit, they have to incur a total cost of 500 and a marginal cost of rupees 200. A marginal cost of rupees 200. What do we mean by the marginal cost? Marginal cost refers to the cost incurred to produce 1 additional unit. marginal cost refers to the cost incurred to produce one additional unit. That is, when the production is increased by one additional unit, the cost added to the total cost is what we identify as the marginal cost. When the production is increased by one unit, the cost added to the total cost is what we identify as the marginal cost. Right. So we will analyze this information. Based on the information, when they produce one unit, I will use a zero output also for my explanation. The firm has to incur a total cost of rupees 500. The firm has to incur a total cost of rupees 500 when they produce one unit. And marginal cost of producing the first unit is how much? Is rupees 200. What does this mean? When the production of the firm increases from 0 to 1, when the production of the firm increases from 0 to 1, the total cost increases by 200. That is the meaning of marginal cost of the first unit is 200. What do we mean by the marginal cost of the first unit is 200? It says that if the production increases from 0 to 1, the total cost increases by 200 rupees. Total cost increases by 200 rupees. So then what should have been the total cost at a zero level of output? What should have been the total cost at a zero level of output? If the total cost increases by 200 to 500, the total cost at zero output level should be rupees 300. The total cost at the zero level of output should be rupees 300. Total cost of the zero level of output should be rupees 300. We learnt about the short run cost behavior with the previous questions as well. We learnt that when the level of output is 0, the total variable cost is 0. No variable cost is incurred at a zero level of production. No variable cost is incurred at a zero level of production. So the only cost incurred when the level of production is 0 is fixed cost. So therefore, at a zero level of output, this firm is incurring a cost of 300 means what? The total fixed cost of this firm should be rupees 300. Total fixed cost of this firm should be 300 rupees. Now, if we go back to the question, you can see that when the output is 5, the total cost incurred by the firm is 900. So again, total cost comprises of total variable cost and then total fixed cost. Total cost of producing 5 units is 900. We calculated the total fixed cost of the firm, it is 300. So therefore, the total variable cost of producing this quantity of 5 units is rupees 600. The total variable cost is 600 rupees. But we are supposed to calculate the average variable cost. How do we calculate the average variable cost? Average variable cost. We are supposed to calculate the average variable cost of producing 5 units. How do we get the average variable cost? It is the total variable cost divided by the quantity of output. Total variable cost is 600 at 5 units. Therefore, average variable cost of producing 5 units is 120 rupees. Average variable cost of producing 5 units is 120 rupees. Therefore, the answer for this question should be right answer for the question should be rupees 120. Average variable cost of producing 5 units is rupees 120. Right. We will move on to the question number 6. Identify the incorrect statement. Again, we are supposed to identify the incorrect statement here regarding the behavior of short run cost of production. Right, we will see. In this question, I am giving the focus on the behavior of average cost curves. Right, we are giving our attention on the average variable cost, average total cost, average fixed cost curves plus the marginal cost curve within the short run production process. With a rough diagram, we will identify what kind of behavior is there in the short run average variable cost, average total cost, average fixed cost, and then the marginal cost curves. Quantity of output, value in rupees. Usually the average fixed cost curve is taking this kind of a rectangular hyperbola. Average fixed cost is calculated by dividing the total fixed cost by the quantity. We know that in short run production process the total fixed cost doesn't change. When the level of output increases, the total fixed cost doesn't change within the short run production process. Right? So, therefore, when the level of output increases, the average fixed cost is gradually going down. So, therefore, average fixed cost curve is continuously going down. The marginal cost curve is taking this kind of a U-shaped graph, and then the average variable cost curve is taking this kind of a shape. The average total cost curve is taking this kind of a U shape again. Always in the short run cost behavior, the marginal cost curve is always passing through the minimum points of both the average variable cost curve and then the average total cost curves. The marginal cost curve is passing through the minimum point of the average variable cost curve and then the minimum point of the average total cost curve. But according to this diagram, we can see that there is no minimum point of average fixed cost. Why is it? The average fixed cost is continuously going down. The average fixed cost is continuously going down. As the average fixed cost is continuously going down, we will not be able to identify a minimum point of average fixed cost. But the marginal cost curve is always passing through the minimum points of the average variable cost curve and then the minimum point of the average total cost curve. And the other thing is, the short run average total cost curve is the total of average variable cost curve and then the average fixed cost curve. Short run average total cost curve is the total of average variable cost and then the average total cost. Average fixed cost. I will average variable cost plus average fixed cost. the total of these two is the average total cost. Therefore, the gap between the average variable cost and the average total cost, we will show it in this way. ATC minus AVC, the gap between AVC and ATC always represents the average fixed cost of the firm. ATC minus AVC shows the gap between the average total cost and the average variable cost is showing the average fixed cost of the firm. As the average fixed cost of the firm is continuously going down, the gap between average variable cost curve and the average total cost curve is also gradually decreasing. But average variable cost and the average total cost are never intersecting with each other. They are not connecting with each other at any point. The reason is average fixed cost never becomes zero. Even though the average fixed cost is continuously decreasing like this, the average fixed cost is not becoming zero at any point, because the total fixed cost is anyway there at any output. So when you divide that by a certain quantity, you can get some 0.0 something, but you cannot get 0 as your answer. So as average fixed cost never becomes zero, the AVC curve and then the ATC curves are not intersecting with each other. So this is how we can explain the behavior of the short run average cost curves. We will go to the question. Identify the incorrect statement regarding the behavior of short run cost of production. First answer. The difference between the average variable cost and average total cost gradually decreases along with the increase in production. Difference between average variable cost and average total cost gradually decreases along with the increase in production. We learnt it. So we explained that the gap between AVC, ATC represents AFC. AFC is continuously decreasing. Therefore, the gap between AVC and ATC is also continuously going down. Therefore, the first statement is a correct statement. Second one, marginal cost is equal to average variable cost at the minimum point of the average variable cost. So we'll go back to the question, the diagram we drew. So you can see that the marginal cost curve is passing through the minimum point of the average variable cost, as well as it is passing through the minimum point of the average total cost curve as well. So therefore the second answer is also a correct statement. Third one, when marginal cost is greater than the average variable cost. We will go back to the question, the diagram. Marginal cost is when marginal cost is greater than the average variable cost. Right, look at the diagram. Marginal cost is greater than the average variable cost means the statement is talking about this stage. During this stage only the marginal cost is greater than the average variable cost. This is the AVC we drew. So during this stage only, from this point onwards only, the average marginal cost curve is lying on the top of average variable cost. So during that stage the marginal cost increases, the average variable cost also goes up. So we will read the third answer. When marginal cost is greater than the average variable cost, the average variable cost gradually increases. Yes, it is a true statement. Right. The fourth statement. Marginal cost is equal to average total cost at the minimum point of average total cost. You can see, we learned that the marginal cost curve is passing through the minimum point of the average total cost curve as well. Marginal cost curve is passing through the minimum point of the average total cost curve as well. Therefore, that is also a correct statement. Last one, marginal cost is equal to the average fixed cost at the minimum point of the average fixed cost. That is wrong. Why? If you go back to the diagram we drew, there is no such minimum point of the average fixed cost. The average fixed cost is continuously decreasing. Even after MC and AFC are intersecting with each other, AFC is further going down. Therefore, we cannot say that the marginal cost is equal to the average fixed cost at the minimum point of the average fixed cost. Therefore, the fifth answer should be chosen as the correct answer for this. Why is it? It is a wrong statement. We want to identify the incorrect statement in this set of answers. So, the incorrect statement out of these 5 answers is the 5th answer. Right. Right, we'll move on to the question number 7. Diagram given below is related to a firm operating in short run production. In this diagram, I am focusing on the behavior of the short run product curves and then the short run average and marginal cost curves. We discussed at the beginning that the short run cost behavior is decided upon the the law of diminishing returns. Law of diminishing returns states that when only the variable inputs are increased, mixing with a certain amount of fixed inputs, the marginal product and the average product starts to decrease after a certain point. So, the point where the marginal product curve starts to decrease only the point where the law of diminishing returns are started. So, based on this, we can identify a relationship between the product curves and the cost curves, the short run product curves and then the short run cost curves. Here we are giving our attention to the short run average cost curves. So, you can see that the marginal product curve is increasing at the initial stage, and after some point the marginal product curve starts to go down. Right. And this question is identifying the 2 points, maximum point of marginal product and the maximum point of average product. The maximum point of marginal product is at this point, and this is what they have identified as B. Right. So, diagram given below is related to a firm operating in short run production. We'll go to the question. According to the above diagram, when moving from point A to point B, right, moving from point A to point B means what? They are moving from maximum point of MP to maximum point of AP. They are moving from maximum point of MP to maximum point of AP, right, from maximum point of the marginal product curve to the maximum point of the average product curve, PVC. So, during this stage, we will see what kind of a behavior is there in the cost curves, marginal cost curve, average variable cost curve, and then average total cost curve. Right. So, when marginal product increases, marginal cost goes down. When marginal product goes to its maximum point, marginal cost goes to its minimum point. And then when marginal product decreases, what happens is marginal cost is going up. Marginal product increases, marginal cost goes down. Marginal product goes to its maximum point, marginal cost goes to its minimum point. and when marginal product decreases, the marginal cost is going up. Therefore, we say that the marginal product curve and the marginal cost curves are representing a mirror effect. And then when average product increases, what happens to the average variable cost? Decreases. And when average product reaches to its maximum point, average variable cost curve reaches to its minimum point. And from that point onwards, when average product curve decreases, what happens is the average variable cost is going up. Therefore, we say that the average product and the average variable cost curves are representing a mirror effect. Average product increases, average variable cost goes down. Average product reaches to its maximum point and average variable cost reaches to its minimum point. And then when average product decreases, what happens to the average variable cost? The average variable cost goes up. So therefore, there is such a mirror effect between the average product curve and then the average variable cost curve. The average total cost curve is also taking a U shape like this, but average total cost curve is not making any mirror effect with any product curve. Right? The mirror effects are there between marginal product curve and the marginal cost curve, and then the average product curve and then the average variable cost curve. So therefore, this question is talking about this range. No? During this range, marginal product decreases like this, the average product increases. So when marginal product decreases, what happens to the marginal cost is increasing, and as average product increases, average variable cost decreases. Right. So the question is, according to the above diagram, when moving from point A to point B, marginal cost as well as average variable cost increases. Wrong, we identified that during this stage the marginal cost increases and then the average variable cost goes down. So we will directly go to the answer. The first answer cannot be accepted. Second one, marginal cost as well as average total cost increases. Wrong. Marginal cost decreases. Wrong. So we should not read the rest part of the answer, as the first part itself is wrong. Marginal cost increases, correct, and average variable cost decreases. We will go back to the diagram. Yes, it is marginal cost increases and then the average variable cost decreases. Marginal cost increases and then the average variable cost increases. So we should identify the fourth answer as the correct answer for this. Marginal cost increases and average variable cost decreases. Marginal cost increases and average variable cost decreases. That is how we can identify the answer for this question. Right, question number 8. Diagram below shows the long run average cost curve of a firm. Right. I gave a brief explanation regarding the long run cost of production at the beginning when we are learning about the short run and the long run for the first question. There, what did we mean by the long run? Long run refers to the time period in which the production is increased by increasing all types of inputs. All inputs become variable within the long run production process. All inputs become variable within the long run production process. The economic theory which explains the behavior of long run production process is the law of returns to scale. The law of returns to scale identifies the relationship between the percentage change in the inputs and then the percentage change in the outputs. The law of returns to scale identifies the relationship between the percentage change in the inputs and then the percentage change in the outputs. Right. There are three types of returns to scale: increasing returns to scale, constant returns to scale, and then decreasing returns to scale. If output increases at a higher percentage than the percentage increase in the inputs, we identify that as increasing returns to scale. But if output increases at the same percentage of increase in the inputs, we identify that as the constant returns to scale. Also, if output increases at a lower percentage than the percentage increase in the inputs, we identify that as the decreasing returns to scale. So, based on the behavior of law of returns to scale only, the long run average cost curve is, the shape of the long run average cost curve is decided. We identify this kind of a flat U-shaped graph as the long run average cost. We can divide this long run average cost into three stages. Long run average cost decreases, the long run average cost remain constant, and then the long run average cost increases. Long run average cost decreases, long run average cost remain constant, and then the long run average cost increases. When there are increasing returns to scale, what do we mean by the increasing returns to scale? If output increases at a higher percentage than the percentage increase in the inputs, we identify that as increasing returns to scale. So, when there are increasing returns to scale, the long run average cost decreases. Right? The long run average cost decreases when there are increasing returns to scale. And when there are constant returns to scale, the long run average cost remain constant. When there are constant returns to scale, the long run average cost remain constant. And when there are decreasing returns to scale, what happens to the long run average cost? The long run average cost increases when there are decreasing returns to scale. The factors which support for this per unit cost to go down in the long run production are identified as the economies of scale. Economies of scale are the reasons which support for the long run per unit cost to go down. So, therefore, when the firm gains economies of scale, right, the long run average cost decreases. And when there are when the firm experiences diseconomies of scale, the long run average cost will go up. The long run average cost will go up when the firm experiences the diseconomies of scale. So, the question is, when this firm is expanding their level of output from 0 to A, right, they are expanding their level of output from 0 to A. So, during this stage, what happens is the long run average cost decreases during this stage, right? The long run average cost decreases. There are increasing returns to scale, right? Output increases at a higher percentage than the percentage increase in the inputs, right? So, there are some factors which are supporting for the long run average cost to go down, that is, there are economies of scale during this stage, right? These are the things which we can see during this stage from 0 to A. So, we will read the answers. First one, firm gains economies of scale, yes, correct, and long run average cost decreases. Yes, the first answer itself is correct. Why? During this stage, the economies of scale are there to the firm, right? The long run average cost decreases, right? So, therefore, the first answer itself can be taken as the answer for this question. Right. Firm gains economies of scale and the long run average cost decreases. Answer number 1 is the answer for question number 8. We will move on to the question number 9. Under which of the following situations accounting profit and economic profit are equal to each other? Think you can remember that we did an explanation regarding the accounting profit and then the economic profit. In that discussion we discussed that accounting profit is obtained by deducting the total explicit cost from the total revenue. Accounting profit is total revenue minus explicit cost. But how do we calculate the economic profit? Economic profit is total revenue minus economic cost. But economic cost comprises of two components. What are those? Explicit cost and then the implicit cost. We'll write down the two equations. Accounting profit is TR minus explicit cost. But economic profit is TR minus explicit plus implicit cost. TR minus explicit cost plus implicit cost. So the question is talking about a situation where the accounting profit and economic profit are equal to each other. A situation where the accounting profit and the economic profit are equal to each other. So accounting profit is TR minus explicit cost, whereas economic profit is TR, the total revenue minus explicit cost plus implicit cost. So if this implicit cost was 0 only, if this figure is 0 only, now for an example, say the total revenue is 50,000 and say the explicit cost is 20,000, then the accounting profit will be how much? 30,000. Here again the total revenue is 50,000. Explicit cost is still 20,000. But if implicit cost is 0, for some reason if there is no implicit cost, then what happens? The economic cost altogether will be 20,000. Economic cost will be 20,000, so 50,000 minus 20,000 is 30,000. Therefore economic profit of the firm will be 30,000. So economic profit and then the accounting profit will be equal to each other only if the implicit cost is 0. Only if the implicit cost is 0. So therefore when explicit cost is 0, no. When explicit cost is equal to the implicit cost, no. When economic cost is 0, no. When economic cost exceeds the accounting cost, we cannot take so. But when implicit cost is 0, as we calculated and showed here, when implicit cost is 0 like this only, this can happen. So therefore answer 5 should be taken as the answer for this question. When implicit cost is 0, the accounting profit will be equal to the economic profit, right? Why is it? The implicit cost is 0 means the explicit cost is the only thing which is deducted from total revenue from under both instances. So therefore the two answers will be equal to each other. Think you understood. We will move on to the question number 10. The short run marginal cost of producing good X is indicated by the schedule below. Actually, this is a past question from 2011 A-level. So we will see how to do this question. Given that total fixed cost is rupees 30, at what level of output is short run average total cost lowest? They want us to identify the lowest average total cost. So in arriving at the answer for this kind of a question, we should develop a small schedule based on the given information. With that only we should arrive at the answer. So again we will read the question. The short run marginal cost of producing good X is indicated by the schedule below. The number of units plus the marginal costs are given there, and at the same time the question says that the total fixed cost is 30. As we discussed with the previous questions too, when the level of output is 0, no variable cost is incurred, only the fixed cost is incurred at the 0 level of output. So therefore at a 0 level of output, only a fixed cost is incurred by the firm and no variable cost is incurred. So the total cost is equal to the total fixed cost at a 0 level of output. Right. So we will develop a small schedule based on this information. Quantity of output, I will start from 0. Right, and then the next column I will prepare for total cost. They have given us the marginal cost. So if we go back to the question says that the total fixed cost of the firm is 30. Fixed cost of the firm is 30. So based on this, the total cost at the 0 level of output is 30. Why? We found out that the fixed cost of the firm is 30. At a 0 level of output, variable cost is 0 and only fixed cost is incurred. Therefore, at 0 output, the total cost is 30. And then the question says that the marginal cost of producing the first unit is how much? 30. Marginal cost of producing the first unit is 30. What does this mean? When the production increases from 0 to 1, the total cost increases by 30. Marginal cost of first unit of output is 30 means what? When the production increases from 0 to 1, the total cost increases by 30. And when the level of output is 0, the total cost is 30. When the level of output is 0, the total cost is 0. Total cost is 30. So when the level of output increases from 0 to 1, if the total cost increases by 30, the total cost should be 60 at the level of output of 1. When the level of output is 1, the total cost should be 60. How? When the level of output is 0, the total cost is 30, which is the fixed cost. And marginal cost of producing the first unit is 30 means what? When the production increases from 0 to 1, the total cost increases by 30. So from 30 by 30 it goes up to 60. And then marginal cost of producing the second unit is how much? Marginal cost of producing the second unit is 20. So therefore, right, marginal cost of producing the second unit is 20. Therefore, total cost should be 60 plus 20 should be 80. 80 plus the next marginal cost is how much? 16. Therefore, the total cost should be 96. The next marginal cost, that is the marginal cost of fourth unit, is how much? Marginal cost of fourth unit is how much? 24. Right? Marginal cost of fourth unit is 24. Means what? The total cost should be 120. And marginal cost of fifth unit is 40. Right? Means the total cost is 160. Also, the marginal cost of sixth unit is 56. Right? So therefore, this is 56 means the total cost should be 260. But here we identified the total cost based on the marginal cost and the fixed cost given. But the question is regarding the average total cost. So we have to prepare a column for average total cost as well. We have to prepare a column for average total cost as well. You are aware that the average total cost is the total cost divided by the number of units of output. Average total cost is total cost divided by the number of units of output. Right? So we will calculate the average cost at each output level. Right? So we don't calculate average cost at 0 output. So 60 divided by 1 is 60. 80 divided by 2 is 40. 96 divided by 3 is 32. 120 divided by 4 is 30. 160 divided by 5 is 32. And 216 divided by 6 is 36. If you can remember the shape of the average cost curve, average total cost curve of a firm, the average total cost curve is taking this kind of a U shape. The average total cost curve is taking this kind of a U shape. So, if average total cost started to increase after a certain point, from this point onwards, if ATC increases, the ATC will not go down from that point onwards. So, now if you can see, right, ATC decreases from 60 to 40 to 32 to 30, and from this point onwards it increases like 32, 36. So after the ATC started to increase, as it is taking a U shape, no point of like identifying or expecting a further reduction in ATC. That doesn't happen. Therefore, based on this information, we can identify the output which gives the lowest ATC, that is this. The lowest ATC is at this point. The lowest ATC is given at 4 units. Based on this, the answer should be four units, the answer number 3. 4 units, the answer number 3. Right. Right. We will move on to the question number 11. When a firm increases all its inputs, including labor and capital, traditionally we use labor to identify the variable inputs and capital to identify the fixed inputs as some traditional terms. When all its inputs increases by 40%, what happens is its output increases by 30%. When all the inputs are increased by 40%, so see, percentage increase in the inputs is 40%, and percentage increase in the output is how much? 30%. Percentage increase in the inputs is 40%, right? And percentage change in the output is 30%. So inputs are increased by 40% and output increases by 30%. So the percentage change in the output is less than the percentage change in the inputs. We already learned that if percentage change in the output is less than the percentage change in the inputs, that if percentage change in the output is less than the percentage change in the inputs, we identify that as decreasing returns to scale. We identify that as decreasing returns to scale. If all inputs are increased, we cannot identify that in relation to the short run. We already learned that in short run we only increase the variable inputs and we do not increase the fixed inputs in the short run. Think you understood. VVC. Diminishing returns are experienced by the firm. No, diminishing returns are seen in the short run. Diminishing returns, law of diminishing returns, diminishing marginal returns, all these terms are used to identify the law of diminishing returns. So that is related to the short run. The second one, long run average cost increases during this stage. We learned that the long run average cost curve takes this kind of a flat U-shaped diagram. The long run average cost curve takes this kind of a flat U-shaped diagram like this. So when there are increasing returns to scale, long run average cost decreases. When there are constant returns to scale, long run average cost remain constant. And when there are decreasing returns to scale, the long run average cost gradually goes up. So therefore, the second answer, long run average cost increases during this stage, is correct, right? But we are supposed to identify the wrong statement, right? The first statement is wrong, we identified it, but we will see the others as well. Third, diseconomies of scale are seen during this stage. Yes, we discussed in a previous question, during this stage there are diseconomies of scale. Firm experiences decreasing returns to scale, exactly yes, because percentage change in the output is less than the percentage change in the inputs. This is seen in long run production process, is also yes. So therefore, out of these 5 answers, the only wrong statement is the first answer. The diminishing returns are experienced by the firm. Wrong. Diminishing returns are seen in the short run production process, and this explanation is based on the long run production process. Right. Right. So the section that we did up to this point are focused on the cost of production, the behavior of cost of production of a firm which engages in the production of a good or a service. And from this point onwards, we are giving the focus on the market structures. Based on the number of firms in a certain industry and based on the nature of the product produced by the firms in a certain industry, based on the availability of entry-exit barriers to a certain industry, and then based on the availability of information, we categorize markets into 4 categories. So again, what are the criteria used to categorize market structures into different categories? The number of producers in the industry, nature of the product produced by the firms in the industry, right? And then the availability of entry-exit barriers to that respective industry, and then the availability of information. Based on these criteria, we are categorizing markets into 4 categories as perfect competition, monopoly, monopolistic competition, and then oligopoly market structure. So from them, what do we mean by the perfectly competitive market model? The perfectly competitive market is a market where there are a large number of firms in the industry. Usually each firm is supplying only a very tiny supply to the total market supply of that respective industry. And every firm produces a homogeneous product. What does it mean? From the quality point of view, size, price, everything, the ingredients used, everything are same. One product, the product produced by one firm is 100% exactly equal to the product produced by another firm. We do not identify any difference between the product produced by one firm over the product produced by another firm. That is what is meant by a homogeneous product is produced. So therefore, a large number of firms are there. Every firm produces a homogeneous product, and there are no entry-exit barriers to the industry. Any firm who wishes to enter into the industry can easily do so. Any firm who wishes to move away from the industry can do so. And then availability of perfect information. What do we mean by availability of perfect information? Regarding the cost of production, the production technology, the ingredients used, the market price, everything is freely available to know by everyone. So a market structure having these characteristics only is identified as a perfectly competitive market model. So we identify a firm in perfect competitive market model as a price taker. What does this mean? A price taker is a firm which has to sell its total output at the decided market price, and that firm cannot create any influence on the decided market price. A price taker cannot create any influence on the decided market price. Only thing what a price taker can do is to sell all what they produced at the decided market price. That's it. We identify a firm in perfect competitive market model as a price taker because of 3 reasons. Because of the fact that there are a large number of firms in the industry. Every firm produces a homogeneous product, and perfect information is available from both the consumers and producers' point of view. Because of these reasons, because of actually these characteristics of perfect competitive market model, a firm in perfect competition is identified as a price taker. If a single firm decided to charge a higher price than the decided market price, what happens is no consumer will be buying from this respective firm. Why? There are enough other firms in the industry to sell the same product at a lower price than that. So in that case, what is the point of paying a higher price and buying from that respective firm? Therefore, a single firm is unable to charge a higher price than the decided market price. To the other way, in perfect competitive market model, we identify small scale firms. Every firm produces a very tiny supply to the total market supply. Like if you see the paddy cultivators in Sri Lanka, paddy farmers in Sri Lanka, the supply made by a single farmer to the total paddy supply of Sri Lanka maybe some 0.00 some point percentage, right? So therefore a single farmer has the ability, in relation to the general discussion, a single producer is having the ability of selling its total output at the decided market price. So at a situation where a single firm has the ability of selling all what they produced at the decided market price, there is no reason for a firm to charge a lower price than the decided market price. So in one hand, a firm in perfect competition cannot charge a higher price than the decided market price. and on the other hand, a firm does not need to charge a lower price than the decided market price as well. So the only thing a firm in perfect competition, perfectly competitive firm is doing is whatever they produce is sold at the same decided market price. Right? So therefore we say that a firm in perfect competition is acting as a price taker. So we will go to the question. Which is not a characteristic of perfectly competitive industry? There are a large number of firms, yes. There are no entry-exit barriers, yes. Availability of perfect information, yes, we see there. Individual firms are acting as price takers, I explained. And then last, product produced by firms may be homogeneous or differentiated is wrong. Why? We identify that a firm in perfect competitive market model is always producing a homogeneous product. The product produced by one firm is exactly equal to the product produced by another firm. So therefore we do not identify the product differentiation in relation to the perfect competitive market model. So therefore we need to identify the factor which is not a characteristic of perfectly competitive industry. Product differentiation is not seen in perfect competition. So therefore we cannot say that they are producing a homogeneous or a differentiated product, but it is always a homogeneous product. So the answer number 5 should be taken as the answer for question number 12. Right. We will move on to the next question. Question number 13. Right. One thing what we need to know is, right, we are learning about the market structures in the market structures section, and we are learning about different market structures. The cost behavior does not depend upon the market structure being considered, only the revenue behavior changes upon the market structure being considered. So the cost behavior is commonly applied for the firms. Right. Right. So following details are given in relation to a firm operating in perfect competition within short run. What we are supposed to do is to calculate the fixed cost of the firm. Actually, even with the previous explanations, we learned that we are supposed to calculate the total fixed cost here. But in this diagram, we only find out average variable cost and the average total cost. Based on this discussion, we can use the relationship between ATC, AVC and AFC, that is AVC, average variable cost, plus average fixed cost is equal to the average total cost, is equal to the average total cost. So using this diagram, actually they have given us 3 outputs, no? Right, they have given us 3 outputs. What are the 3 outputs? 300 units, 400 units and then 500 units. 300 units, 400 units and then 500 units. Right. So from these 3 outputs, at a certain output, if you can get the exact gap between AVC and ATC. Now if you see 500 units, at 500 you cannot identify any of the 2 values. Cannot exactly get AVC at 500 units and cannot exactly get ATC also at the 500 units. Also if you take 400 units, at 400 units ATC is there, right? At 400 units, if you go along with 400 units to the ATC curve, you can identify the ATC at 400 units. But the problem is, at 400 units, you cannot get the exact amount of ATC. The value is not given. So for this calculation purpose, you cannot use 500 units and then you cannot use 400 units as well. And then if you look at the last value, the other value, the remaining value 300, if you go along with this 300 units to the ATC curve, the ABC of 300 units is how much? Is 40. And when you go along with these 300 units to the ATC curve, the corresponding value is 60. So if this firm is producing 300 units, average variable cost is 40 rupees and average total cost is 60 rupees, right? When they are producing 300 units only, all this information is applicable. So at 300 units, average variable cost is 40 rupees and at 300 units, average total cost is 60 rupees, right? So average, again we will go back to the diagram. At 300 units, ABC is 40, ATC is 60. ATC is 60 and average variable cost is 40. What is not known is average fixed cost. With that we can calculate the average fixed cost. It is 60 minus 40 is equal to average fixed cost. So average fixed cost is 20. How do we calculate the average fixed cost when the total fixed cost is given? Average fixed cost is total fixed cost divided by the number of units of output. So average fixed cost multiplied by the quantity of output gives you the total fixed cost, right? So we can form an equation saying total fixed cost equals to average fixed cost multiplied by the number of units of output. We found out the average fixed cost at 300 units as 20, right? So average fixed cost is 20 at 300 units. So when you multiply 20 by 300, you will get the total fixed cost. The total fixed cost at not at a certain output. We know that the total fixed cost does not depend upon the number of units of output. No, the total fixed cost does not depend upon the number of units of output. Therefore, the total fixed cost of the firm being considered is 6,000, right? The total fixed cost is 6,000. So therefore, the answer number 2 should be taken as the answer for this question, right? Right, question number 14. A diagram is given. According to the above diagram, if the firm is currently producing at Q1 output, right? This question is trying to identify the profit maximizing condition of a firm in perfectly competitive market model. This question is focusing on the profit maximizing condition of a firm in the perfectly competitive market model, right? There are two approaches we use to identify the profit maximizing output of a firm in perfect competition. The two approaches are the total revenue total cost approach and then the marginal revenue marginal cost approach, right? So from these two approaches, this question is focusing on the marginal revenue marginal cost approach. In usual applications, what is mostly applied in the questions is the marginal approach of arriving at the profit maximizing output. So with the numerical presentation, before moving to this question, I will give a brief explanation regarding the profit maximizing condition of a firm in perfectly competitive market model. Right. What do we mean by the marginal revenue? The marginal revenue refers to the addition to the total revenue. Marginal revenue refers to the addition to the total revenue when the number of units of sales is increased by one additional unit. Right? Marginal revenue is the revenue added to the total revenue when the number of units of sales is increased by one additional unit. And what do we mean by the marginal cost? The marginal cost refers to the addition to the total cost when the number of units of production is increased by one additional unit. Right? Marginal revenue refers to the addition to the total revenue when the number of units of sales is increased by one additional unit, whereas the marginal cost shows the addition to the total cost when the number of units of production is increased by one additional unit. So, my focus is with an example to explain the profit maximizing condition of a firm in perfect competition based on the marginal revenue and the marginal cost. So, therefore, I will use some values. We will say the price of this product is rupees 400, right? So, the marginal revenue of a firm is, as I told you, is the addition to the total revenue when the number of units of sales is increased by one additional unit. No. A firm in perfect competition is acting as a price taker. A firm in perfect competition is acting as a price taker. We discussed it. Means every additional unit a firm in perfect competition sells should be sold at the same market price. Should be sold at the same market price. Means what? The same price only is added for each additional unit it produces and sells. So, therefore, the marginal revenue is equal to the price of a firm in perfect competition. So, the marginal revenue curve is starting from price and is moving parallel to the quantity axis. And then the marginal cost curve is taking this kind of a U shape because of the law of diminishing returns applied in the short run production process. Right. So, we will say that this firm is producing one unit. We will say that this firm is producing one unit. So, in order to get the marginal cost of this first unit, we have to go along with this to the marginal cost curve and identify the corresponding value. So, the additional cost incurred to produce the first unit is 500 rupees. But in order to calculate the marginal revenue of the first unit, we should go along with this one unit to the marginal revenue curve and should identify the value. So, therefore, if this firm produced one unit, marginal revenue of that unit is rupees 400 and the marginal cost of that unit is 500 rupees. Marginal cost of producing that unit is how much? Is 500 rupees. Right? So, if they produce the first unit, in order to produce it, we have to incur a cost of 500, whereas the revenue gain from that unit is rupees 400. So, therefore, there is a profit, actually not a profit, but there is a loss of rupees 100 from the first unit. The firm will have to incur a loss of 100 rupees by producing the first unit. The cost incurred to produce the first unit is rupees 500. The revenue gained from the first unit is rupees 400. Therefore, there is a loss of rupees 100 from the first unit. Now, say this firm is planning to produce the second unit, then what happens? I will take the second unit like this, and the corresponding marginal cost is like this. Right? So, see, when the second unit is produced, the marginal revenue is 400, but the marginal cost of producing the second unit is 450. Marginal cost of producing the second unit is 450. right? Marginal cost of producing the second unit is 450. Cost incurred to produce second unit is 450, but that unit is sold at 400 in the market, means the firm faces for a loss of 50 rupees from the second unit, right? From the first unit, firm faces for a loss of 100, and from the second unit, the firm faces for a loss of rupees 50. Altogether, the loss increases to 150. Altogether, the loss increases to 150 by producing 2 units. And if they produce the third unit, what happens is, if they produce the third unit, the marginal cost and the marginal revenue of both, marginal revenue of the third unit, both of them are 400 each. Means what? There is no profit or no loss when they produce the third unit. From the third unit only there is no profit or no loss, only from that respective third unit, right? So profit or loss is 0, but they have to, in order to produce the third unit, they have to have produced the first unit, no? And they have to have produced the second unit, no? Afterwards only they can produce the third unit. So therefore, the loss is standing at the same 150 when they are producing 3 units. And now say they are producing the fourth unit, right? Producing the fourth unit. The marginal revenue is this much, 400. The marginal cost is this much. We will take it as 300. The marginal cost of producing the fourth unit is, take weight, 300, whereas the marginal revenue is 400, right? So if the fourth unit is produced, the marginal revenue gained by the firm is 400. The marginal cost incurred by the firm is 300. Therefore, there is a loss. Therefore, there is a profit of rupees 100 from the fourth unit. So, with the first 3 units, they were already at a loss of 150. From the fourth unit, they are generating a profit of rupees 100, and when that is set off, their loss will go down to 50. Their loss will go down to 50. And now say they are producing the 5th unit as well. They are producing the 5th unit as well, right? They are producing the 5th unit. How much is the marginal cost? Marginal revenue is same everywhere, no? So I will take 200 as the marginal cost of producing the 5th unit. So if this firm produced the 5th unit, marginal revenue of that unit is 400 and marginal cost is 200, and that creates a profit of 200 to the firm. So the total profit minus 50 plus 200 will go up to 150, right? And if they produce the 6th unit, what happens is, again the marginal revenue is 400 and the marginal cost something more than the previous one. So I will take some 220 rupees. So if they produce the 6th unit, the marginal revenue is 400, the marginal cost is 220. Therefore, there is a profit of rupees 180. So when that profit is added to the previous accumulated profit, the profit goes up to 330. And now we will say this firm is producing the 7th unit, right? The 7th unit is produced by the firm. Marginal revenue is again 400. And marginal cost of producing the 7th unit is 300. Therefore, the firm makes a profit of rupees 100 by producing that respective unit. And when that profit is added to the previously accumulated profit, the total profit goes up to 430. right? And now we will say that the firm is producing the 8th unit. What happens? Marginal revenue is 400 and then the marginal cost is also 400 if they produce the 8th unit, right? Marginal revenue is 400, the marginal cost is 400, therefore there is no profit, no loss, right? Therefore profit is 0. The accumulated profit of 430 is still there with them, right? And now we will say that they are producing the 9th unit for some reason. If they increase the production from 8 to 9, what happens? The marginal cost of producing the 9th unit is this much, which is 500, but the marginal revenue is still 400. So for some reason, if they produce the 9th unit, what happens? They get a revenue of 400. But the cost incurred to produce that unit is how much? 500. Means from that unit there is a loss of 100 to the firm, right? When that loss is adjusted to the previously accumulated profit, again the profit goes down from 430 to 330. Again the profit goes down from 430 to 330. So what is the point of producing the 9th unit? No point of increasing the production from 8 to 9. No. Why is it? After the MR is equal to MC at the 8th unit, from that point onwards, the marginal cost curve is again exceeding the marginal revenue curve. From that unit onwards, if the firm produced even one additional unit, the cost incurred to produce that additional unit is greater than the revenue gained from that additional unit. Means what? The firm faces for a loss from that respective unit. When that loss is adjusted to the total profit, the profit starts to go down, right? So therefore we say that based on MRMC approach, the profit maximizing condition of a firm is based on based on MRMC approach, the profit maximizing condition of a firm is the level of output at which the marginal revenue is equal to marginal cost. But if you carefully observe this diagram, there are two such points where the marginal revenue and the marginal cost are equal to each other. One is this, the other one is this. I will take them as point A and point B. But both points are not identified as profit maximizing outputs. Both points are not identified as profit maximizing outputs. At this output, which is 3 units, you can see what happens. The losses of the firm are maximized, not profits, right? Therefore the profit maximizing condition is where the marginal revenue is equal to the marginal cost at the increasing stage of marginal cost. Marginal revenue should be equal to the marginal cost at the increasing stage of the marginal cost. That respective output only is identified as the profit maximizing output of the firm. That respective output only is identified as the profit maximizing output of the firm. So therefore the profit maximizing condition of a firm in the perfectly competitive market model is the point where the MR is equal to MC at the increasing stage of the marginal cost curve. In the question, if we go back to the question is talking about Q1 output, right? The question is talking about Q1 output, right? So if you go back to the diagram we drew, right? So Q1 output is something like the unit number 6, no? Somewhere here, right? For some reason, if the firm produced only 6 units and stopped their production at 6 units, what happens? At 6 units, their total profit is only 330. As the equilibrium output of a firm, we are identifying the profit maximizing output. the quantity at which the maximum profit is achieved by the firm. The quantity at which the profit is maximized by the firm, right? Even though the firm is at a profit at 6 units, that is not the maximum profit based on this. The maximum profit is 430, which is achieved at 8 units. Therefore, if they produced only 6 units and stopped their production at 6 units, what happens is they will lose some more profits that they could achieve by increasing their production from 6 to 8, right? So therefore, and the other thing is, with the MR equals to MC condition, we are just identifying the level of output at which the firm maximizes the profits. That's it, the level of output, the quantity only. But whether the firm is at a profit or not cannot be identified based on the MR and MC, that we will see separately with a separate question. So according to the above diagram, if the firm is currently producing at Q1 output, based on the diagram we drew, if they are producing only 6 units, what they should do? In order to increase the profit, they should increase the level of production, right? Profits of the firm are maximized. No, we learned. Should decrease the production to maximize the profits. No. The firm is at a loss. No, we cannot say by just looking at MR and MC the profitability. Should increase the production to maximize the profits. That is the answer for this question, right? Firm should increase the production in order to maximize their profits. So according to this diagram, if they are producing only 6 units, they should increase it from 6 to 8 further to increase their profit from 330 to 430. Right. Right. Question number 15. Following are the revenue and cost curves of a perfectly competitive firm. What we are supposed to find out is the total fixed cost of the firm, total variable cost of the firm, and then the economic profit, right? And further, the question says that the current price is rupees 50. We learned that the marginal revenue is equal to the price, no? So if the price of the product is rupees 50, that should be the marginal revenue. Anyway, the question gives it. Question has identified them as the marginal revenue and then the average revenue curves, right? And the other thing is, they have given us only 2 quantities of output. They have given us only 2 quantities of output, right? So first thing what we are supposed to do is to calculate the total fixed cost. No? Calculation of total fixed cost can be done at any output, any possible output. Based on this diagram, at a certain output, if you have both ABC as well as ATC, you can calculate the total fixed cost. If you have both ABC as well as ATC at a certain output, you can calculate the total fixed cost, right? So at 120, you can find out ATC is 40, but you can't find out the exact amount of average variable cost at 120. It is not given. So if you go along with this (120) to AVC, his respective value is not given, no? So we can't find out the average variable cost at 120, but at 100 units, I see average total cost is 50 and average variable cost is 30, right? So at 100 units, again ATC is AVC plus AFC. At 100 units, AVC is 30, ATC is 50, right? ATC is 50, AVC is 30 and AFC is not known. So if you take 30 to the other side, what happens? That becomes minus. So average fixed cost at 100 units is 20. So the total fixed cost is average fixed cost multiplied by the quantity. So it is 2000. So it is 2000. So average fixed cost of the firm is 2000. There are two answers given with 2000. These are the two answers. Answers should be one out of these two, because the total fixed cost is 2000 based on the calculation we did. Based on the calculation we did, the total fixed cost is 2000. So therefore there are only two answers. And the question has given you, right, the question has given you that the price of the product is rupees 50, no, right? And based on the previous discussion that we learned that the firm should produce the level of output where the marginal cost and the marginal revenue are intersecting with each other at the increasing stage of marginal cost. Therefore they should produce this output of 120. Right, they should produce the level of output of 120. At 120 units, if we go to the average total cost curve like this, and if you identify that corresponding value, the average total cost of producing 120 units is, the average total cost of producing 120 units is rupees 40, right? Average total cost is rupees 40. We know that it is, sorry, with this we will calculate the average total cost is rupees 40 at the equilibrium output of 120 units. Therefore total cost is average total cost multiplied by the quantity. Average total cost is 40 at how many units? At right, the average total cost is 40 at 120 units. So should multiply this by 120 to get the total cost. So how much is the total cost? Is 4800. And we know that the total cost is the total variable cost plus the total fixed cost. Total cost at 120 units is 4800. And how much is total fixed cost? Is 2000, and that doesn't depend upon the number of units. The total variable cost only changes from one level of output to another level of output. The total cost at 120 units only is 4800. Right, total cost is 4800 at 120 units. And total fixed cost is 2000 at every point. Therefore, the difference between these two is 2800. Therefore, the total variable cost of the firm at the equilibrium output should be 2800. Right? Fixed cost. Right? Fixed cost. Fixed cost is 2000, we found out that, and the variable cost is 2800. This must be the answer. Why? Like, even though the fifth answer is also saying that the fixed cost is 2000, the variable cost is different, no? But now we found out that the variable cost at this output is 2800. So the answer 4 must be the answer. But anyway, we will calculate the profit of this firm as well, economic profit. At 120, equilibrium output is this much and the price is rupees 50. So we will calculate the profit. Right? Profit should calculate by deducting the total cost from the total revenue. But in this diagram, we don't have the total cost and total revenue information. No? In this diagram, we don't have total revenue and total cost information. So therefore, we can calculate the total revenue by multiplying price by quantity. Also, we can calculate total cost by multiplying average total cost by the quantity. Right? Price is 50. Right? Price is 50, average total cost is 40 and quantity is 120. Right? Price is 50 at the quantity of 120. Average total cost is 40 at the quantity of 120. So total revenue is 6000, total cost is 4800. Therefore, economic profit is 1200. So all the three conditions or all the three figures are fulfilled or completed or complying at the quantity of 4 units. Total fixed cost is 2000, total variable cost is 2800, and then the economic profit is 1200. Right. Right. Question number 16. The diagram below is related to a perfectly competitive firm. The diagram below is related to a perfectly competitive firm. Right? According to the above diagram, we will read the first answer to get an approach to the question. The first answer says firm earns a supernormal profit at the equilibrium output as average revenue is greater than the average cost. Right? Now we learned that the equilibrium condition should be the point where the marginal revenue curve and the marginal cost are equal to each other. That happens at, and it should be at the increasing stage of MC as well. It should be fulfilled at the increasing stage of the marginal cost. So that happens at this point, no? Right? That happens at this point. As I discussed with you, the MR equals to MC condition only identifies the profit maximizing quantity of output. That's it. The quantity at which the profits of the firm are maximized only is obtained through the condition of MR equals to MC. But whether the firm is at a profit or not is decided upon the total revenue and total cost at that respective output. If total revenue is greater than the total cost at this output, the firm is at a profit. We identify that as a supernormal profit as well. But if total revenue is equal to the total cost, the economic profits are zero. Also, at the equilibrium output, if total revenue is less than the total cost, the firm is at a loss. Now, based on this diagram, actually the figures are not given. Only thing what is given is the price, and price is rupees 80. Just having the price, we can't do anything, like we can't do the calculation of profit. And in the answers, they are not expecting us a figure. We just need to conclude whether the firm is at a profit, loss, or zero economic profits. Now, the firm is producing this quantity, no? Right? Profit should be calculated by deducting total cost from the total revenue. Total revenue minus total cost is the way you should calculate the profit at a certain output. When you have the price and the quantity the firm should produce, the quantity the firm should produce, if you take it as, I will just take it as P1. So by multiplying price by the quantity, we can calculate the total revenue. Total cost should be calculated by multiplying the average total cost at this respective output. How do you get? We go along with this output to the ATC curve and identify the corresponding value, this value, right? So there is a certain average total cost value you get here. That ATC value you get here, the respective ATC value we get here should be multiplied by the corresponding quantity to get the total cost, right? We will go for a diagram. In that question, the price is rupees 80, the marginal cost curve goes like this, and average total cost curve goes like this, no? So when we want to calculate the profit at this respective output, why is this respective output? Because that is the point at which the marginal revenue and marginal cost curves are intersecting. So Q1 is the quantity they should produce, right? So again, the profit is total revenue minus total cost. Total revenue should be calculated by multiplying price by the quantity. Total cost should be calculated by multiplying the average total cost by the quantity. Our price is rupees 80. I will use some value for my explanation. I will use this as 100 units. So then 80 into 100 gives you the total revenue. How much? 8,000. Right. And in order to get the ATC at this quantity, we should go along with this quantity to ATC curve and should find out the corresponding value. Maybe say some 60. So ATC is 60 at the quantity of 100 units. So the total cost is 6,000. Means what? The firm makes a profit of rupees 2,000. So therefore, at the equilibrium output, at the point where MR equals to MC condition satisfies, if the price of the product is, which is this, right, greater than the average total cost, if at the equilibrium output, if price is greater than the average total cost, at the equilibrium output if price is greater than the average total cost, the firm will make a supernormal profit. The firm will make a supernormal profit. So therefore, again, right, the equilibrium output is identified based on MR equals to MC condition. Based on MR equals to MC condition, only the equilibrium output is identified. That's it. The quantity the firm should produce is identified based on MR equals to MC condition. That's it. But at this respective output, whether the firm is at a profit or not should be identified by comparing the price and average total cost. So at the equilibrium output, if price is greater than ATC, at the equilibrium output, if price is greater than average total cost, then the firm will make a profit, right? So therefore, the first answer itself, right? Firm earns a supernormal profit at the equilibrium output as average revenue is greater than the average cost should be identified, but we will go for the other answers as well. A firm earns a supernormal profit at the equilibrium output as the marginal revenue equals to marginal cost. No, you cannot come into such an answer. Why? Marginal revenue equals to marginal cost is just giving you the equilibrium output, the quantity the firm should produce in order to maximize profits. That's it. Whether the firm is at a profit or loss cannot be calculated based on MR equals to MC. Just it is giving you the quantity the firm should produce, right? So the firm is at a profit because of the fact that the price is greater than the average total cost at the equilibrium output, because of the fact that the price is greater than the average total cost at the equilibrium output, and not because of the marginal revenue is equal to the marginal cost. So the second answer also cannot be taken as an answer. Firm earns a normal profit, wrong. Firm earns a normal profit, wrong. Fifth answer, equilibrium output cannot be decided, is also wrong, right? So therefore, the answer should be the first answer. Firm earns a supernormal profit at the equilibrium output as the average revenue is greater than, I can tell you, price is exactly equal to the average revenue, right? That you can see in the diagram also, right, which is the price. So therefore, the firm earns a supernormal profit because of the fact that the price is, or the average revenue is greater than the average total cost. Think you understood the explanation. We will move on to the next question. Right. Question number 17. A perfectly competitive firm earns a total revenue of rupees 8,000 by selling 100 units. Right? Marginal cost at this output is rupees 80. If the average total cost at 100 units is rupees 60, we will see. Again, we will use a rough diagram to analyze this question. Right? A rough diagram. Marginal cost, marginal revenue. We'll go back to the question. What do they say? A perfectly competitive firm earns a total revenue of 8,000 by selling 100 units. Right? Total revenue is price into the quantity. Right? They are producing 100 units and getting an income of how much? 8,000 by producing 100 units. So how much should be the price? Price should be rupees 80. Right? Price is rupees 80. Right? Right. We found out the price. Marginal cost at this output is also rupees 80. What does it mean? They are currently producing the point where marginal revenue and marginal cost are equal to each other, because at this point the marginal cost is also rupees 80, no? Right? They are currently producing the point where marginal revenue is the price, right, which is rupees 80. The question says that the marginal cost is also 80. The question says that the marginal cost is also 80. Marginal cost is also 80. So the firm is currently producing the output at which the MR equals to MC condition satisfies, means they are currently producing the profit maximizing output. And the question says, if the average total cost at 100 units is 60, average cost is less than the price, the average revenue. Price, marginal revenue, average revenue, both of them are the same in perfect competition, right? So average total cost is 60 means what? At the equilibrium output, the average total cost should be something less than the equilibrium output is 100. So average total cost is 60. Right? These are the details actually given in this question, right? Based on this, we will move on to the answers. Firm should maintain the current production by, actually yes, by, they are currently producing the profit maximizing output, where the marginal revenue is equal to the marginal cost, right? Firm should maintain the production, yes. Firm is currently at a profit, yes, exactly. Why? Right? Price is rupees 80, average total cost is 60. Price is greater than the average total cost. Price is 80, average total cost is 60. Actually, we can calculate the profit and show it. How? As I told you, profit is TR minus TC, no? TR is price into quantity. TC is ATC into quantity. Price is 80. Quantity produced is 100. Average total cost is 60. Quantity produced is 100. So this is 8,000. This is 6,000. Therefore, the profit of the firm is 2,000 rupees. So therefore, firm should maintain the current production and firm is currently at a profit. We'll read the other answers. Firm should increase the production. No, because they are currently producing the MR equals to MC condition, the output at which MR is equal to MC. We explained with the previous explanation that a firm should produce the output where the marginal revenue is equal to marginal cost in order to maximize their profits. Firm should shut down the operations. There is no reason for them to shut down the operations as they are at a profit. Firm is currently facing for a loss is wrong. Firm should maintain the current production even though it faces for a loss. That is also wrong. We found out that the firm is at a profit. So therefore, the answer number 1 should be the answer for question number 17. Think you understood. Question number 18. A perfectly competitive firm is operating at a decided market price of rupees 120. Marginal revenue, marginal cost and average variable cost are equal to each other at the quantity of 400 units. If the total fixed cost of this firm is equal to 12,000 rupees, identify the correct statement regarding the equilibrium output of this firm. We will see. The question says that the price is rupees 120, marginal revenue is marginal cost and average variable cost are equal to each other. Right? According to the question, the marginal revenue, marginal cost and the average variable cost, all of them are equal to each other. All of them are equal to each other. We will see. We will use a rough diagram again to understand what they are talking about. So according to the question, the price is rupees 120. Price is rupees 120. Marginal revenue, marginal cost and average variable cost are equal to each other at the quantity of 400 units. These are like at this point marginal cost, average variable cost, marginal revenue. Now we know that in perfect competition price and marginal revenue are equal to each other. Therefore, if the market price is rupees 120, the marginal revenue curve should also start from 120 and move parallel to the quantity axis. The marginal revenue curve should also start from 120 and move parallel to the quantity axis. So, at 400 units only, all these things are equal to each other. Therefore, the question is talking about this respective quantity and this point. Right. If the total fixed cost of the firm is rupees 12,000, identify the correct statement regarding the equilibrium output. We'll go back to the question. Now, if average variable cost is going like this, the average total cost must be anyway on the top of AVC. No? Average total cost is average variable cost plus average fixed cost. Therefore, if AVC is this, ATC must be on the top of AVC. ATC must be on the top of AVC. And the firm is producing 400 units. Right? So, when we are calculating the profit, how do we calculate the profit? Again, it is TR minus TC. Right? TR is price into quantity. Price is 120, quantity is 400. Right? Therefore, total revenue is 48,000 rupees. Total revenue is 48,000. Total cost is, we will say in this way, total cost is, based on this information, we can say TVC plus TFC. I will just take it as fixed cost. The TVC is AVC is 120. Quantity produced is 400. Therefore, total variable cost is 48,000 rupees. Total variable cost is 48,000. Plus the total fixed cost is given in the question as 12,000. Therefore, total cost of the firm is 60,000. So, therefore, there is a loss which is equivalent to the fixed cost. Actually, this loss can be shown by moving along with this quantity. We get the corresponding ATC. No, this is the ATC at the equilibrium output. So, price is this, ATC is this. So, in this situation, price is less than the average total cost. Price is less than the average total cost. Right? So, this whole rectangular area shows the loss of the firm, right? Because the average total cost is greater than the price of the firm at the equilibrium output. So, therefore, the firm is at a loss of rupees 12,000. The firm faces for an economic loss of rupees 12,000 at the equilibrium output. So, answer number 4 is the answer for question number 18. Answer number 4 is the answer for question number 18. Question number 19. In the short run, even if average revenue is less than the average cost, It will pay a firm to continue in business so long as average revenue is greater than, right? This question is regarding the shutdown condition of a firm in perfect competition. This question is regarding the shutdown condition of a firm in perfect competition. Based on the behavior of cost of production in short run, the total variable cost is avoidable in short run. That is, if the level of production is 0, the total variable cost is 0. But the fixed cost is not avoidable in the short run. The fixed cost is to be incurred even at a 0 level of production. The fixed cost should be incurred even at a 0 level of production. Therefore, within the short run, the fixed cost is unavoidable, no? Right? Within the short run, the fixed cost is unavoidable. We know that the profit is calculated by using the formula TR minus TC. Right? We know that TC is the sum of TVC and TFC. TVC and TFC. It is the total cost. If output is 0, the total revenue is 0. When there is no output, the total revenue is 0. And the total variable cost is also 0. But fixed cost won't be 0. If fixed cost of the firm is 20,000 for an example, the firm will face for a loss which is equivalent to the fixed cost of the firm. Right? So, therefore, when the level of output of a firm is 0, the total revenue is 0, the total variable cost is 0, total revenue is 0, total variable cost is 0, but the total fixed cost is incurred. The fixed cost is incurred means, based on this explanation, you will realize that the firm will incur a loss which is equivalent to the fixed cost of the firm. Firm will incur a loss which is equivalent to the fixed cost of the firm. So by carrying out the production, if they can maintain their loss at a lower level than the fixed cost, right? If they did not produce, they will incur a loss which is equivalent to the fixed cost, right? Loss is equal to the fixed cost. So if the firm can produce an output and maintain the loss, if the firm can produce an output and maintain the loss at a lower level than the fixed cost, the firm should carry out that level of production. Now for an example, say this firm produce some output and say they get a revenue of some, say they produce some output and they get a revenue of some, say 15,000. Say they are earning a revenue of 16,000, just say so, 15,000. And say at this point the total variable cost is 10,000. Just an example, right? So total revenue is 15,000, total cost is 30,000. The firm faces for a loss of rupees 15,000. The firm is at a loss. At a certain output, total revenue is 15,000, total variable cost is 10,000, right? And the total fixed cost is 20,000. Therefore, the total cost is 30,000. The total cost is still greater than the total revenue. Therefore, the firm is facing for a loss of rupees 15,000. The firm is facing for a loss of rupees 15,000. But you must understand, if they did not produce, as we already discussed, they will face for a loss of rupees 20,000 if they did not produce. But by carrying out the production, they can maintain the loss at how much? 15,000. They are at a loss. But the loss incurred by carrying out the production is less than the loss that they have to incur if they did not produce. Loss incurred is less than the loss that they have to incur at zero output. So therefore they should produce, right? So therefore, as far as a firm is receiving a total revenue, as far as a firm is receiving a total revenue greater than the total variable cost. In this example, total revenue is 15,000, the total variable cost is 10,000. So from the total revenue, after recovering the variable cost, a part is there to the firm to recover at least a part of this unavoidable fixed cost. Therefore, the firm should carry out the production. So, as far as the total revenue of a firm is greater than the total variable cost, after recovering the variable cost from the total revenue, at least a little amount is there to recover at least a part of the fixed cost. Therefore, the firm should continue to produce. Right? But for some reason, if total revenue is equal to total variable cost, I will take an example here. Say the firm produces an output, total revenue is 12,000. The total variable cost is also 12,000. Therefore, the total cost will be 32,000. This is 12,000. Total cost is 32,000. So the firm will be incurring a loss which is equal to 20,000. Right? So if the total revenue is equal to total variable cost, from the total revenue, once the total variable cost is recovered, nothing is remained. Therefore, the loss incurred by the firm will be equal to total fixed cost. Right? If they did not produce, again they will have to incur a loss which is equal to the fixed cost. But for some reason, if the total revenue of the firm is even less than the total variable cost, we will take an example. We will say the total revenue of producing some output is 10,000. Total variable cost, I will keep it as it is at 12,000. Then what happens? Total revenue is 10,000. Total variable cost is 32,000. Sorry, not the total variable cost, but the total cost. What happens to the loss? The loss of the firm is 22,000. Loss incurred by the firm at present is more than the loss that they have to incur if there is no production. The loss incurred by the firm is more than the loss they have to incur when there is no production. So therefore, right, a firm does not engage in the production if total revenue is less than the total variable cost. A firm does not engage in the production if the total revenue is less than the total variable cost. So at least the firm should be able to recover their total variable cost from their total revenue in order to carry out the production. Therefore, the shutdown condition of a firm in the perfect competitive market model is this, that is TR equals to TVC, or else in other words, total revenue divided by quantity is price, total variable cost divided by quantity is average variable cost. So at least the price of the firm should be equal to the average variable cost in order to carry out the production by a firm. At least the price of the firm should be equal to the average variable cost in order to carry out the production. Right. Question number 20. Following details are related to a firm operating in a perfectly competitive market. Now we will see. Unit price of the product is how much? Rupees 150. Price is 150. And marginal cost is how much? The marginal cost is also rupees 150. What does it mean? They are currently producing the profit maximizing output. They are currently producing the profit maximizing output. And we learned that the shutdown condition is price equals to ABC. As far as the price received by the firm is more than the average variable cost, price received by the firm is 150. Price received by the firm is 150. Average variable cost is given as 120. So price is more than the average variable cost. So therefore the firm is receiving a price more than their shutdown price, and then the price is equal to MC, or in other words MR equals to MC condition is satisfied at the moment, right? MR equals to MC condition is satisfied at the moment. So therefore the profit maximizing condition is satisfied at this output, and then the price is more than the shutdown price. Therefore they should maintain the current level of production. Right? Therefore we should accept the fifth answer for the 20th question. So we did a discussion focusing on the fourth lesson of the syllabus, cost of production and market structures. So giving attention to the cost of production, the market structures separately, we discussed few questions, right? Along with the questions we discussed the applicable theoretical areas for those questions. Think you understood this explanation. We will meet with another discussion along with a different lesson, right? So thanking to Bank of Ceylon for giving me this opportunity to contribute to this great social responsibility project. I will stop for the discussion. We will meet on another discussion in the future. Thank you.